Okay, so foreign direct investment, otherwise known as FDI. We're going to be talking first about global growth in FDI, so how the patterns of FDI look around the world, and how FDI is different as a form of investment from other forms of investment, principally financial portfolio investment, and what that means for the management decision-making process. So, FDI financial flows are absolutely huge. If you look back at 2008, total FDI was $1.5 trillion. It's fluctuated over the years. So world FDI exceeded $2 trillion back in 2015. It then started to fall away, plunged to what looks to me like about $1.2 trillion over there in 2020, and then has risen again. The majority of this fluctuation has been down to the developed economies. You'll notice that developing economies are pretty stable throughout. I say stable, I might also mean stagnant. There isn't an awful lot of growth there, is there? In fact, there's not much fluctuation at all. There seems to be a suggestion here that the reason for FDI in developing economies is one that doesn't change from one year to the next. And if that's the case, it also suggests that developing economies are not attracting, accelerating quantities of FDI, and therefore it's not something that they can use or are using as part of their economic development, which is a bit of a surprise because it's meant to be. And as part of globalization and increasing globalization, you would expect there to be increasing amounts of FDI going into these economies. And you'd also expect it to react to changes in the global economy. We are seeing that in the developed economies. And while reasonably stable from 2008 to 2014, it then shot up in 2015 and 16. I don't know why. All I can do is describe what's happening, which is exactly what I don't want and nobody wants when you're analyzing a chart or a graph. So if you've got a chart or a graph in your assignment that you're submitting in a week or so time, I would want to know the story behind this. What you would need to do if you wanted to find out the story, and it is the story we need. We don't just want a description of what's going on. We need to find out the story. Is you can look up the UNCTAD, United Nations report for, well, if you wanted to know about 2015, you'd have to go for the 2016 report that would give you that 2015 data. Anyway, it's all in the website, and the link is given in the last slide in this series. So where's it all coming from? United States, understandably up at the top, the world's largest and wealthiest economy. Be aware that the FDI outflow for the United States is so huge, it won't fit on the page. This has been abbreviated. So it's actually going on for nearly double this length, yeah, for 2021, so absolutely massive. Of course, 2020 much lower because of the pandemic, so that would have reduced investment opportunities overseas. Germany, a wealthy country over here, number 2, then Japan, another wealthy country. China here at number 4. But I think China should really be combined with Hong Kong, China, in which case China is really number 2 by quite a long way. So, in fact, the United States way out in front, China an easy second, but still quite some way behind the United States, and then Germany some way behind China. And then after that, it's much more predictable, a much more stable profile here to the decline in the numbers. Yeah. Interesting one here, United Kingdom, big overseas investor. but 2020 was a disaster. Now, you can say it's the pandemic, but all countries were suffering from the effects of the pandemic. Must be Brexit, yeah? Ireland, exactly the same, a big overseas investor, a bit of a surprise there. So why is it such a big overseas investor? It's such a tiny country. Population somewhere around about the size of London, I suppose. I can't quite remember, maybe 10 million people or something like that. And a huge drop in 2020. And you can't say it's, well, I suppose you could say it's Brexit, because their economy is closely tied to the United Kingdom. They're slowly trying to detach themselves from the United Kingdom and trade directly with the EU rather than trading through the United Kingdom, which was fine when we were members of the EU, but we're not anymore. Okay, what else to say about Ireland? Why is it such a big investor overseas? Well, the thing about Ireland is that it's the home or the European location for many of the big United States multinationals, companies like, say, Google and Microsoft. Who else is there? Twitter, I think, is there. So that would then become the base of their European investments. So that's why in 2020, they would have stopped investing in Europe from Ireland, and hence that huge drop there. Okay, where's it all going? Right, now this is perhaps where it becomes a little more interesting, because it all appears to be going to the United States. Same problem here, that the sums going into the United States are so huge they can't fit it onto the page, so they have to abbreviate this column. This column should be about twice as long as this. Also, China and Hong Kong, big recipients of FDI. So if you add these two together, let's see, 140, 220, 320. So not too far behind the United States, actually, 320. But then when you get down to Singapore, Singapore then goes into third place, doesn't it, if you combine the two Chinas? Long, long way behind. What do we see that's in common with all of these? Well, United States developed economy, China, Hong Kong, China, well, Hong Kong surely is developed. China, mainland China would be an emerging economy. I think Singapore is meant to be an emerging economy, but it's very advanced, so maybe developed, really. Canada developed, Brazil emerging, 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 emerging. No developing economies. So all of this money is by preference going to the developed economy of the United States. And then we've got money going into China and Hong Kong because of the rapid economic development. Yeah. So in other words, foreign direct investment is mostly attracted to fast-moving or developed economies, is seeking out these investment opportunities. There's a lot of talk about it being a tool of economic development and therefore useful to developing economies, but actually the data is saying that that is not what's happening. How is foreign direct investment different then? What makes it distinctive? And this is an idea, concept first put forward by Stephen Heimer, who was looking at investment flows around the world and noticed there was a distinct difference between a pure financial investment, which is like a portfolio investment. In other words, if you're investing your money, you would try to diversify the risk in your portfolio by having a selection, a broad selection of investments. You don't want to be exposed to just one kind of investment. You want to spread yourself over an array of different opportunities. And as part of that, a company making its own investments would invest overseas just to make sure that it's diversified internationally. Now, these portfolio investments, just as it is for an individual, these portfolio investments are very quickly unwound. If you're a private investor, you can just sell your shares in a matter of minutes. And I suppose it's more or less the same thing for a company. FDI, though, Stephen Heimer noticed, is more long-term. There's some kind of commitment to the investment, and that makes it difficult to unwind. What do we mean by long-term? Well, it depends on the industry. And in some industries, long-term means just a few years. So retail, it depends on a case-by-case basis, but Tesco invested in a new retail chain in the United States and started the investment and then shut it down over a period of about 5 years. So I'd say with retail, long term, is right about half a dozen years. If you were starting up a car company, 5 years is what you need just to set it up. So, well, I suppose you could look at, say, General Motors and Ford buying up Saab and Volvo in Sweden. And that investment in both cases lasted, I would say, about 10 years. So long term, and that's buying an existing manufacturer. So 10 years, yeah, that sounds about right. If you were starting from scratch, so what they call a greenfield investment, I would have thought it'd be much higher than that, 15 to 20 years.
Understanding foreign direct investment. Foreign direct investment, or FDI, refers to a long-term investment by an investor in an enterprise in another economy, resulting in lasting interest with significant influence over the overseas enterprise. FDI typically occurs through mergers and acquisitions or setting up of business operations by the investor in a foreign economy. The investor is known as the direct investor, while the overseas enterprise is known as the direct investment enterprise. For example, when a company based in Singapore invests in an enterprise domiciled overseas, the Singapore-based company is the direct investor, and the overseas firm is the direct investment enterprise. The transactions captured will be recorded in Singapore's outward FDI. Conversely, inward FDI is recorded when a foreign direct investor invests in Singapore. How is FDI measured? FDI is measured by the sum of three components. Equity capital, invested by the direct investor in the direct investment enterprise. Retained earnings accrued to the direct investor, which are earnings generated by the direct investment enterprise after deducting the dividends payable to the direct investor, and net intercompany loans between the direct investor and the direct investment enterprise. FDI is typically positive, but in some instances could be negative, such as when the value of loans from the direct investment enterprise to the direct investor is larger than the loans from the direct investor to the direct investment enterprise. For example, a Singapore-based company's outward FDI in another economy in the ASEAN region will include the equity capital invested by the Singapore-based company in an enterprise in that ASEAN member state, retained earnings recorded by this enterprise, as well as net intercompany loans between the Singapore-based company and the enterprise. Let us visualize how FDI can change over time. In year 1, Company X, which is based in Singapore, invested $50 million in equity capital in Company Y, domiciled in a foreign economy, resulting in Singapore's outward FDI stock increasing from $0 to $50 million by the end of the year. In the following year, another $10 million is invested in equity capital, raising the FDI stock to $60 million as at the end of year 2. In year 3, Company X lends $40 million in intercompany loans to Company Y, raising Singapore's outward FDI stock to $100 million as at the end of year 3. With $10 million in earnings at the end of year 4 and dividends payable amounting to $4 million, the FDI stock at the end of year 4 stands at $106 million. What are the benefits of FDI? The host economy benefits from FDI through job creation as well as knowledge and technological transfers. For investors, undertaking FDI helps them build distribution networks and gain access to new technologies or natural resources. Singapore's inward FDI has grown considerably since the early 1970s. Foreign multinational enterprises have been actively investing in Singapore, which contributed to our economic expansion over the years. As Singapore's economy grew, outward FDI has become increasingly pivotal to our growth strategy. More companies based in Singapore internationalize to seek new opportunities abroad. For more information on foreign direct investment statistics, its related concepts and methodologies, visit www.singstat.gov.sg.
Okay, I think that was a fairly clear explanation. I'm not sure if that will actually make it to the recording of this lecture. I often find that YouTube goes silent, or the video won't work when you have a look at the recording. But anyway, you've seen it now. The core point about FDI then is that this is about parental control. So the parent company or the investor wants to have managerial control of some part of the target company's process. Now, it could be production, it could be marketing, it could be research and development. It might be that the investor wants to have access to raw materials. Is any part of the value or supply chain. That managerial control, at the minimum, according to the OEC definition, needs to be around about 10% ownership. But you could argue about this, because in some cases, 10% the ownership of the target enterprise is actually less than 10%, but the investing company, the FDI company, has some kind of special managerial skill, or it's got some technical knowledge, or it's got business knowledge of some kind that gives it additional influence. So it may have an ownership level that's less than 10%, could even be zero. And a student of mine, a PhD student, was looking at this, and she found that there were companies in Turkey where the ownership level by the investor was actually zero. So Turkish ownership was 100%, but because the overseas company had some special managerial talent or product knowledge or something like that, that gave them the influence. So it's still counted as FDI according to her definition. What then are the motivations for FDI? And John Dunning has put forward 4 motivations for FDI. The first is natural resource seeking. So a company, an investor, is looking for a supply of raw materials. They want to secure it over the long term. So that's why it's FDI and not portfolio. They're going to be there for the long run. Also, it could be that they're looking for market opportunities. Again, it's for the long run. Yeah, they're not just going to be in there skimming the market, making a fat profit, and then exiting as soon as things turn bad. They're in there for the long run. Perhaps they're looking for strategic assets. So maybe through a merger or an acquisition, they acquire a proven local company or a proven distribution network. And finally, and perhaps the one that we're most aware of in the West is efficiency seeking. So looking for low labor costs, for example, starting up a factory in a country like Cambodia, or in the case of Levi Jeans, they had an operation in Lesotho, which is an independent kingdom surrounded by South Africa. And because there are different forms of FDI, different motivations for it, there have been different patterns, explanations of how it actually comes about. The earliest theory was the product life cycle theory. You know the product life cycle. You introduce a brand new product. So you start off with the introduction phase, then growth as sales begin to pick up. Rapid growth then leads to maturity and the sales levels even out, they plateau, and then you go into decline. And the idea is with the product life cycle is that when a product goes into decline and you're trying to strip out cost of manufacturing because there aren't big profits to be made anymore, you're not investing in the product very much, you're not advancing the product anymore because that kind of investment won't give you a long-term return since the product's clearly on the way out. What you can do is shift everything over to a low labor cost region. So you reduce the cost of production. You're not researching the product. You're not going to develop the product, which seems like a very reasonable thing to do. Until you realize that because of globalized markets, it's not really possible to say, take something, I don't know, Kindle. Let's take the Kindle tablet book reading device. That did reasonably well in Europe and America for a while. Then it went into decline when people realized they actually preferred real books. Maybe you can shift production to Cambodia, Vietnam, somewhere like that. Except if the Kindle is that popular, then in Cambodia and Vietnam, they would already have it. Markets are globalized. There might be a delay of 6 months, even a year, between the launch of Kindle in the United States and the launch of Kindle in Cambodia, but it's not going to be any more than that. So it's not like you can go into that market after 10 years and announce it to that market in a big flourish, just as it goes into decline in the United States. So the product life cycle theory of FDI has been superseded by the practicalities of globalization. Uppsala stage theory, I can't remember whether we've looked at this. I think we might have done briefly, but that says that companies internationalize in stages. What does this mean? Well, stage 0 is doing nothing. Stage 1 is exporting from the home location. Stage 2 is, I think, from memory, stage 2 is something like setting up your own distribution network in an overseas market. And what are we up to? Stage 3 is manufacturing. So stage 3 is FDI. The problem with the Uppsala stage theory, intuitive and rational though it is, and supported by certain examples though it is, there are many companies that actually invest overseas in complete defiance of any sort of sensible, steady stage theory. A good example would be McDonald's. McDonald's can't go from just being in the United States to exporting, because if you go into a McDonald's in Paris and ask for a Big Mac, it's not much good if they say, that's fine, it'll take 6 months for it to arrive from the United States. It's got to be made there. It's got to be made straight away. So McDonald's would go straight in at stage 3. They would set up production in that target market straight away. They can't go through the different stages. So Uppsala stage theory does not explain the patterns of FDI. What I mentioned before about Ford and General Motors investing in Sweden. So Ford bought Volvo, General Motors bought Saab. There seems to be a sort of strategic compulsion to this. It looked as though both Ford and General Motors at the time had a lot of money. They were looking for places to invest. Ford were the first. They bought Volvo. And I think General Motors seemed to be consumed with envy. And very, very shortly later, they then bought Saab. And I'm not sure they really needed Saab. General Motors and Ford were both very big in Europe already. and it was a bit confusing. Ford, I'm just trying to think whether Volvo was still making trucks in those days. They might have bought the entire company, cars and trucks. Volvo Trucks is now an independent company. It's separate from the car company, and a huge concern. It's possibly the biggest truck manufacturer in the world, but it'll be in the top 3, top 4, top 5. Anyway, so Ford bought Volvo. Let's say it was in 1990. I can't remember exactly when, around about 1990. Within a year, General Motors had bought Saab. It didn't work out for Ford, so they backed out of Volvo after about 10 years. And within a few months, really, General Motors then sold Saab. Both Volvo and Saab, as I'm sure you're aware, now owned by Chinese companies. And that'll be part of their strategic, global strategic expansion. You can also think of FDI being about a foreign currency hedge. This is an interesting position because if you manufacture in the market, in your target market, it means that as the currency fluctuates, you're sort of protected from the worst effects of it. If you're exporting to a market and the currency, your own currency increases in value, that'll put your prices up. And that will mean that you'll find it difficult to compete in your target market because you're having to either put all your prices up or cut your profits as you maintain prices there. If you manufacture in that market, as the currency changes in value, you can keep your prices there constant because you're buying all your components there. All your costs are in that market. Yeah? So you no longer have to deal with the change in the actual cost of what you're selling. What will change, though, is the value of the profits you now report in that market. And this can cause fluctuations in the book value and the reported revenues, because it's going to go through what they call translation effects as you translate the value of one currency into your own currency. So if your currency goes up in value, that can make your profits overseas, and I'm trying to think whilst I'm actually saying this, if the value of your currency goes up, then that means that I think the overseas profits in your books, as you report them, can look as though they're falling. That's what I think. It might be the other way around, but I'm not clever enough to think and talk at the same time. A foreign currency sink. Now this is a tentative idea, and we'll return to it shortly. It's the idea that in a country there may be too much foreign currency, so they need to get rid of it, and the government will therefore encourage companies to spend money overseas, or they'll tolerate them spending money overseas, because otherwise these companies are just accumulating more and more foreign currency and they haven't got anywhere else to really spend it. Types of FDI then. Brownfield is where you buy an existing asset, an existing company, existing facilities, and what you're looking for is quick entry. So it's already up and running. The people there have local market knowledge. You're also actually getting rid of a potential competitor. So if you're wanting to go into the supermarket sector, as Walmart did coming into the UK, they could have tried setting up their own supermarkets and being in competition with the existing British ones, one of which would be Asda. Asda are in more or less the same market segment as Walmart, so a fairly cheap, low budget supermarket. Well, much better, Walmart just buys Asda and they get that quick entry, they've got ASDA's market knowledge, and they're not having to compete against ASDA, which of course would have been extremely difficult in a saturated market such as the supermarket sector. On the right there is Battersea Power Station in London. I don't know if you know this building. It's quite a landmark in London, and it's been bought by a Malaysian consortium, and they fitted it out as a shopping mall. That means they're not getting local market knowledge. They're not eliminating a competitor. This is a good question, really. I haven't asked the question. The question is this really brownfield just because they've bought the existing building when everything else about their investment is brand new? And you might think in those terms then that perhaps it's a what we would call a greenfield investment. It's a brand new investment. Doesn't literally have to be in a greenfield. And what's happening here is you're getting no pre-existing problems. So if you're the expert at doing something, it means you can start from scratch. You can train all the workers up in your way of doing things. Commonly then, Japanese manufacturers, car manufacturers, when they went into America and into the UK, they built brand new factories. They weren't interested in taking over the existing manufacturers. Toyota could have bought General Motors, but if they'd bought General Motors, they'd have bought all the existing problems. Cars that don't have much of a quality reputation, they'd have bought all of that. They'd have bought all the bad design going on. And Toyota, obviously, wouldn't want to do that because they have superb design and they have superb quality. So they would want to go for a greenfield site. And all of the other Japanese manufacturers did as well. And it also meant that they kept control of their brand image, and could continue to base their success on the strength of that brand in the United States upmarket. And they always had total strategic and operational control. And you might suggest, therefore, that the Battersea Power Station example I gave before is actually greenfield then. Okay, the shell of the building is pre-existing, but after that, they're not running a power station. They can do the project as they want. The brand there, I suppose they're buying into the brand, aren't they? Because Battersea Power Station is a famous landmark, and that I guess is what they purchased. A compromise then would be a joint venture. So you share ownership 50-50 with a local company, and that means that just like a brownfield investment, you're picking up a lot of the existing market knowledge. The nice thing about going in with a local partner is that you can then achieve together economies of scale, which if you're doing on your own might take you years to build up to. A problem with this is that you have lower managerial control. It's almost like a brownfield site where you're working with an existing workforce. And that's fine unless there are problems with that workforce. So when Toyota first went into the United States, they did it with a joint venture, a General Motors joint venture. But Toyota insisted on having local managerial control. They would run the factory. And that was very important to them because that was partly because that was the knowledge they were looking for. That was the experience they wanted to gain. What's it like to manage an American workforce? But also because that's something they're very good at, and they didn't want to leave it to General Motors. Okay, there are a number of different theories on FDI, and there are theories about companies who own some sort of knowledge or some sort of asset that is unique to them. It gives them a competitive advantage, and therefore when they invest in another country, they're doing it based on that strength. Or they might be investing in the country because there's a local advantage. There's an advantage to that location. For example, commodities, gives them access to commodities or low labor costs or something like that, or it puts them in a nice position with regards to regional markets. Another one is there might be internalization advantages. And when I say internalization, this is about internalizing the supply chain, easily confused with ownership. But internalization is about internalizing the supply chain so that you eliminate the relationship between your company and your supplier. And by eliminating that relationship, you can tie the supplier into your operations. Right, so those are different theories on FDI. However, Dunning put forward the concept of combining all of these theories because he said FDI takes place when all of these factors are in place. So there needs to be an ownership advantage and a location advantage and an internalization advantage. Because Dunning is combining or cherry picking the best of these other theories, this is what we call eclectic. That's what eclectic means, cherry picking. So it's an eclectic theory. He's cherry picked, he's picked the best of these other theories. Because he's being eclectic and he's picking the best parts of these other theories, it means that for his theory to have any validity, all three of these factors must be present. If there's only an ownership advantage, then it's an ownership theory of FDI, not Dunning's eclectic theory. If it's only ownership and internalization, it's still not Dunning's eclectic theory. So for his theory to have any validity, then all three must be present. And the way he says it works is that companies will go through a decision-making process. So first they look at their own ownership advantage. Do they have intellectual property rights? Do they have some kind of competitive advantage in the product that they have the copyright of or the trademark over? And if they do, then they go to the next stage. If they don't, if they're making a generic product, I don't know, like steel, for example, then they stay in the domestic market and they don't engage in FDI. Right, so they have got an ownership advantage in some way. Perhaps it's, I don't know, Coca-Cola, so they own a recipe. Right, what about the location advantage in the foreign country? So are there good production facilities there? Can they get the raw materials there? Is there something about the way that they manufacture that's gives them a competitive advantage? So if you were Toyota, let's see if we can stick with Toyota, shall we? So you've got ownership. Yeah, you've got a great brand, you've got a great product. You're going into, let's go into China. So we've got a locational advantage in that country, a huge market, good workforce, low labor costs, everything's looking great. So that's yes, yes. Right, let's go on to the next stage, advantage from internalizing production. So it's important that this overseas facility is part of your network. You don't want to set up this overseas facility in such a way that is not part of your network. In other words, you don't want to license it to a local producer. And if you do want to internalize it, you don't have to, but if you do want to internalize it, now we've reached FDI. Okay. What happens though if this is not giving you the three yeses that would give rise to FDI? What happens if you've got a product? Well, I mentioned steel, didn't I? What happens if you're manufacturing steel? Steel's a generic product. It's a generic process, but you know that there's a huge advantage to producing locally rather than trying to export something that's heavy and bulky and not of a high price. Yeah? And that's the problem with something like steel. It's not like exporting cars or computers or cameras. You know, these are small, light, high-value items that is well worth exporting. Something like steel is expensive to export, and it's a low-value product. You have to export it in bulk. So you've got no ownership advantage, but there's a definite locational advantage. This would be Tata Steel, Indian company, but they own foreign operations. They certainly still do own a lot of the steel manufacturing in the UK. That's FDI. So the problem we've got with the OLI, the OLI paradigm, as Dunning likes to call it, or OLI theory, as I prefer to call it, because I don't think it's a paradigm, is that the decision-making process can jump some of these stages. And there are only 3 stages. So if you're jumping 2 of the stages, how is the OLI theory working at all? And what I propose then, and you'll find this in my textbook, but that's the only place you will find it, is that of these 3 factors, which are ownership, location, and internalization, sometimes you will find that actually one of them is beyond negotiation. So it's not part of the decision-making process. I guess you could say it's there in the background, but it's a decision that's already been made before you start thinking about FDI. So, excuse me. If you were trying to attract foreign direct investment in your nuclear power stations, as we've been doing in the UK, and we've attracted Chinese funders to pay for these power stations. Now, in that case, location is fixed. Well, certainly the country is fixed. We're not interested in inviting Chinese companies to fund nuclear power stations in France. It has to be in the UK. And also, we would give the investors a precise location. They can't decide, oh, well, I think we'll build a nuclear power station in the centre of London. No, we will say this is the place that's been decided. This is where we want the power station. So that's fixed. Yeah. After that, we can have a negotiation. So, ownership. Does the Chinese investor own some kind of design for a nuclear power station? So that might well be high. Internalization. Is there a feeling that the Chinese investor needs to keep this nuclear power station as part of what they do? So it needs to be as part of their network. And this is where we start to get into a little bit of a controversy with Chinese investors, certainly in the West, because there are always a lot of concerns about high Chinese control. It's not the company that worries us, it's who might be behind the company. And there's a worry that the Chinese government is too closely involved in the company to our liking. That means the Chinese company then have control over the investment. So the Chinese government might have control over our nuclear power stations to the degree that they could possibly switch it off if they disagree with something the UK is doing. So the Chinese investors, they might be wanting very high control. They want high ownership control. So they would want a greenfield site, a brand new nuclear power station, but they will be told where to build it. Now, it could be that they would accept low control, low internalization, rather, but they still want high ownership. And that's when perhaps they would take on a project that is already pre-existing. So we're putting it together, but they would happily take on our design. It would have a Rolls-Royce nuclear reactor in it or something like that. And they would take that on more as an investment as much as anything. Okay, I won't go through the other ones. Well, here's Coca-Cola. So Coca-Cola will not negotiate on their recipe for the drink. But if they were going into the Indian market, internalization you can see here. So they probably don't need to feel that the production facility is part of the Coca-Cola network. Bottling factories around the world are all more or less the same. It's a pretty generic production style. And they're not particularly interested in the precise location, although it would have to be in India. But having said that, because they can export all around that region, Bangladesh, Pakistan, they don't mind where it is in India, and they don't even mind where it is in the region. They could site it in Pakistan if it was more convenient. So Coca-Cola would happily take a joint venture, but they would not negotiate on ownership. Ownership is still there as a factor, but it's something that they've already decided for themselves before they've started the FDI negotiations. Now, I mentioned before about how FDI is seen as a tool of economic development for any economy, really. But obviously, the real interest is whether it'll help developing economies. What they're looking for is something called trickle down. So they haven't got the technology, the advanced technology, they haven't got the advanced production processes or the marketing or the managerial skills. So they invite in an established multinational. And the hope is that they bring in new skills that they pass on to the local workforce, the local supply chain, and the benefits of having that huge multinational in the economy trickle down to local companies. And FDI is seen as a long-term commitment, so it's a long-term source of that capital. Once you've got this FDI investor, this multinational in your country, and it's invested in the facilities, then it's there for the long term. In other words, if you go through some kind of currency crisis, as happened in Asia in 1997, 1998, when that happens, the capital can leave the country in a matter of hours, a matter of minutes even. But with FDI, it can't leave so quickly. I mean, even with all those FDI projects in Russia being shut down, it's taken 6 months to do it. You know, Ford have backed out, Fiat have backed out of Russia, but it's not something they can do overnight. It takes weeks and months to do it, even if they're moving really, really fast. Yeah. So FDI is seen as a tool of economic development for developing countries, but there are a lot of suspicions about it. And it's this worry that FDI is a kind of imperialism, and it's a way of getting those commodities out of the country, its resources really cheaply. Remember, I said that resource seeking is one of the motivations. So it's seen as rather imperial, that the target country is being turned into a colony. The FDI is also quite complex. You can't simply invite FDI into your country and then immediately get the benefits. It's quite difficult to unpick exactly what the benefits will be. And what research has shown is that if the gap between the technology, the incoming technology, and the local technology or the local talents or the local ability is very wide, then actually the trickle-down effect doesn't occur. So in that case, I mean, let's say you are setting up a vaccine research lab in a country like Sudan. Well, any specialist equipment cannot be made in Sudan, and it cannot even be serviced in Sudan. The researchers you have are probably not researchers that exist in the country at the moment. And you can't have partnerships with the universities in Sudan. They're simply not up to the same technical standard. So the research lab would sit there in Sudan like a spaceship, and it would be self-contained. The only thing that would come out of there would be local spending. So the workers there would be well paid, and they would They would go out to local restaurants, cinemas. They would employ local people as gardeners, as cleaners in their houses, but it wouldn't be much more than that. So I mentioned those 4 motivations before. The problem is with the developing economies is those 4 motivations take on a sort of darker tint, if you like. So natural resource seeking, the multinational is not just coming in to secure access, it's actually going to exploit the resources in that country. So it'll employ people at a very, very low salary, is bringing in the technology it needs from outside, is not using the local supply chain. The only benefit is employment, and as I say, this is done at a low rate of expenditure. So a good example would be a diamond mine or a gold mine in a country like, I don't know, Botswana. Botswana's fairly sort of advanced these days, but even so, a lot of the machinery would have to come in from outside, and they'll be employing thousands of local workers, but at a very, very low wage. Now you might be market seeking. So I don't know, Starbucks might go into Ethiopia. Ethiopia is the home of coffee, but the coffee making facilities, the coffee outlets won't be very advanced. Starbucks can go in there with their posh Italian coffee making machines. They can afford to invest in lovely, modern, slick looking coffee outlets and totally destroy the host country's competition and prevent the host country developing its own coffee chains. Strategic asset seeking, so creating these direct links. We've seen that with Ford buying Volvo and now the Chinese, of course. Is it Geely, I think, own Volvo? Yes, they do. I can't remember who owns Saab, but it's another Chinese company. Well, that works nicely for Sweden because it maintains the technology they've already got. But if you're when these big multinationals buy companies in developing economies, often they just totally refashion it and reorganizing it to suit themselves. And then efficiency seeking, well, I've already mentioned this, haven't I, really, about low labor costs. And what the incoming MNC wants to do, multinational corporation, wants to do is to maintain that cost advantage. They're not interested in giving the local workers pay rises. They're not interested in investing in them, in raising their skill set. So they will actually suppress local development. One way of getting around this, or to try and encourage more local benefits, is to have a special economic zone. India does a number of these. So what they do is they try and offer special tax benefits and conditions attached to these FDI funds. So multinationals are invited in, but only if they accept the right conditions. And it can be done in a targeted way. So, for example, in the UK, we used to have a shipbuilding industry that went into decline, very high unemployment. So we would offer tax benefits to Japanese car manufacturers to come in. Nissan came into Northern England, set up a factory, and it's one of the most successful factories in the world. A highly efficient factory. Well-paid workers, no design work being done though. Anyway, so the idea of a special economic zone in a developing economy is that the country can then focus its resources on that one small area. So instead of having to build, I don't know, broadband for the entire country, they just do it for that one area. They don't have to have a huge road system across the country. They just do it for that one area, so they can focus all their resources. And done well, it can completely refashion, reorganize a city. So Chennai in India is one, Bangalore is another. Bangalore does a lot of computer software. Sounds great, and it's meant to be like a pump priming measure. It's meant to get FDI started. The problem is companies don't want to expand beyond the SEZ, their special economic zone. They've got all the advantages by staying there. They don't want to go outside and find there is no infrastructure, there are no tax benefits. It's also a market distortion because it means these rich multinationals who have so many advantages already are being given more. The local government is subsidizing them. And it's also a strong indicator that only the SEZ is worth investing in. In other words, the rest of the country is not worth the investment. So you have to attract investors to the SEZ because they're not interested in the rest of the country. Right, I won't play this video, partly because it's probably getting a little bit out of date. But this is something that you might be interested in, because the FDI coming out of China, and we saw that China is a huge investor overseas and must be a huge investor in the United States. So why is it different?
Well, for more on foreign direct investment into China, let's bring in Arthur Dong, teaching professor at Georgetown University's McDonough School of Business. Always good to have you on.
Thank you, Rochelle. Always great to be on.
Now, Chinese officials say they expect modest foreign direct investment growth in the coming 5 years. What are your thoughts on the policymakers' assertions and the impact that could have on the economy?
Yes, certainly. Based on the pronouncements by policymakers in China, they're seeing a slowdown, relative to the earlier decades in which you had double-digit growth in foreign direct investment into China. Now, despite the fact that China and the United States is continuing to be embroiled in trade disputes, it's remarkable that China's FDI had grown from a base of 150 billion last year to now on track to achieving 160 billion. So despite the fact that we are still in the in the throes of a trade dispute, when you think about companies, particularly American companies and Western companies, they still have a robust interest in investing and entering the Chinese marketplace.
So let's look at their interest then. Which sectors or industries could expect to see the most growth in the coming years, especially when you think about the factors like this 5-year plan and existing projects and policies?
Yeah, based on my observation, I will say that several industries are set to continue a robust investment into China. This whole question of energy transition will be a big one, and those kinds of technologies that are related to energy transition will be very attractive in China and certainly welcome in China, as China also tries to meet its environmental goals. Secondly, I see robust investment and momentum going into the financial services business. So with regard to the recent announcement by Goldman Sachs that China has authorized them to have 100% control of their joint venture in China, firms such as Goldman Sachs and many of Wall Street's major investment banks are going to be eyeing China with additional investments to build up their asset management arms and their wealth management arms in this very, very large potential market. In addition to that, I see the consumer industry, in other words, those companies both in the United States and abroad that are engaged in consumer products, continuing to have a very high interest in China and the rise of the Chinese middle class. And so for those reasons, I think those three particular industries are going to see a continued interest in making investments to both expand their existing operations as well as make new investments to bring in new products and services.
And what about the sectors that could be most at risk of losing investment?
Yeah, I think that the industries that are most at risk are certainly the ones that have been most recently grabbing headlines, such as the educational sector, such as companies that are engaged in e-commerce, such as Alibaba and various types of, online commerce. I think those types of investments will start to, abate. In addition to that, I think anything related to very high technology, I think is going to face some headwinds. The fact being that the United States has imposed very rigorous export controls on a wide variety of technologies amongst American companies. In other words, those technologies and those services cannot be sold into the Chinese marketplace. So this is going to cause some challenges in addition to the ongoing challenge of the microchip industry.
And as you mentioned, you have these tech challenges, supply chain challenges, and also then political tensions. Do you think China needs to resolve some of these existing tensions, say with Australia and the US and Europe, for the FDI to really grow and accelerate?
Yeah, FDI certainly is dependent on three things. It's dependent on existing companies in China, American or foreign companies that want to expand. The second would be companies that are not currently engaged in China but want to enter and open up operations in China. And the third is simply institutional or individual investors who want to buy shares in Chinese companies. What creates uncertainty and risk is the current geopolitical climate. And so when you have these kind of tensions that exist in the countries that you just mentioned, EU, the United States, Australia, greater portions of East Asia, as well as the ASEAN member nations, all of this increases risk and increases uncertainty, thereby having a direct impact on FDI.
Certainly lots to keep an eye on. Thank you, as always. Arthur Dong there, teaching professor at Georgetown University's McDonough School of Business.
Okay, so as I say, I hope that makes it onto the recording for you, and you are able to keep up with the dialogue there. Okay, so China may actually be a special case of outward FDI, and this is actually the cause of a lot of international friction, a lot of suspicion in the West as to what China might be planning, and I think it's something that you would find very useful for me to put before you. You may have other ideas, of course, and you should have other ideas because you're on the other side of the argument. But what I'm going to put before you then are some of the thoughts about Chinese FDI. First of all, China itself is a special case because there's what we would consider to be a capital market imperfection, in the sense that firms have or used to have access to a lot of relatively cheap capital that we could only dream of in the West. So if a Chinese company can access loans much more cheaply, then that changes the nature of the investment. It means they can invest in projects that we would see as too risky, or at least too risky for the cost of our capital. There may be an ownership advantage with Chinese companies in that they have this strong network, what you call guanxi, although you may not pronounce it that way. I'm not terribly convinced of this. I think although you have this awareness of networking and you've got a word for it, I think in the West we also have networking, we just don't call it the same thing, or we don't tend to recognize its primary importance. Partly because we see it slightly as corrupt, really, to use a network in that way. There are also institutional factors. One of them being that the Chinese government is very keen on FDI as part of a foreign influence tool. Yeah. One of the strange things about Chinese FDI is that instead of going for the developed economies with their market opportunities and high rates of return and low risk investment opportunities, is that China appears to be targeting developing economies. I'm not terribly convinced about this, because although the amounts being invested in developing economies are much higher, much higher than the amounts that any Western company would want to put in, because a Western company would see the developing world as too high risk, still the sums of money China is putting into the developing world compared to the developed world are still relatively small. Right, so why is China doing it? Why is it raising anxiety levels in the West? Because it looks as though China is trying to buy overseas influence, and it appears at its very worst that the Chinese government is trapping developing countries in debt. So it's a debt trap, and by weighing down these countries with debt that they owe to China, then they also owe a kind of political allegiance as well. So it's about buying strategic partners, but doing it in an exploitative way. China also has this unfair advantage in, well, we say it's an unfair advantage in cheap capital. Much of it based on the huge foreign currency reserves, by far the biggest foreign currency reserves in the world, to the value, I haven't checked recently, but $4 trillion, whereas America's own foreign currency reserves will be in the level of a few hundred million, nowhere near the trillions that China has. And China doesn't seem to be interested in market size. It's not trying to buy its way into huge developing countries. It seems to be quite happy to pick on small ones. And often it's about seeking out resources, so securing access to rare earth metals, which are useful in the production of batteries, so lithium-ion batteries for all those computer devices, electronic devices, and of course electric cars coming in. And this may mean that China is buying its way to the top of the BRIC countries, and is going to end up rivaling the United States in terms of foreign influence over foreign countries. Okay, so that was just a brief review there of how we perceive Chinese expansion through FDI, and of course the famous Belt and Road Initiative, and I forget what you call it in Chinese, but I'm sure you're familiar with it. That's building a sort of modern equivalent of the Silk Road. It's often not a physical thing, or that it often is. It's railways and things like that, but it's a much bigger, broader project than that. In fact, funding for it has been falling off recently. So it's a possibility that the Chinese government is not finding it as useful and as successful as they once did. I used to go to Ethiopia a fair bit. I used to go once a year, and I noticed that the Chinese were building or funding a project in Addis Ababa for a tram system. Now, we have tram systems in this country, and they are enormously expensive, and there's often not much of a business model for it, even here. So the idea that there would be a good business reason for building a tram system in Addis Ababa is completely escapes reason, as far as I'm concerned. So, it is very strange what the Chinese government is doing, investing in high risk projects with a very low rate of return. Okay, so what about employability? So with FDI, you get these big multinationals coming into, say, your country, and this can have an impact on your opportunities and your training, your experience as a manager. So if you can get a job with Toyota in China, well, you are working with one of the most successful and most efficient companies in the world. So incredibly valuable experience. And you get experience then in quality control, Kaizen, which is this concept of continuous improvement, how to work with the shop floor workers, the production line workers. So it's very good for industrial relations. And you're going to be trained to a very high standard. So what I'm saying on employability is that it's a good idea to seek out these multinationals in your country and get employment experience with them. And then, of course, you set up your own company or you work for a Chinese company and you pass on those skills. Right, that's the end of it. So some sources here. I mentioned the UNCTAD World Investment Report, which is where I got the data from in the beginning. Do have a look through this. It's actually an easier read than you might think. So it's worth a look through. And that, I do believe, is it. So let's